Good morning. We will begin with accounting for debentures. What is the difference between a preference share capital, debenture, and equity share capital? What is the income to the shareholders? Interest or dividend. Preference share capital, it is dividend. What about debentures? Interest. Dividend when declared. Only when it is declared by the company, there is an income for the equity shareholders. But here you will get dividend at a fixed rate. What about voting rights? No for preference shareholders, no for debenture holders, yes, only for equity shareholders. Who can become directors of the company? Preference shareholders cannot become, debenture holders cannot become, only equity shareholders can become directors of the company. Okay. Then if you look at the type of fund, this is part of shareholders' funds. This is a borrowed fund. Otherwise, you call it as non-current liability. This is also called as shareholders' funds. Okay. Then if you look at this one, conversion. Yes, preference shares can be converted into equity shares at the option of the holder. Yes, but equity share, why do you convert? Okay, so these are the major differences. And if you look at expense for tax purpose, preference shares dividend is an appropriation of profit. So not deductible as expense for tax. In debenture interest can be claimed as an expense. Otherwise, debenture interest is a charge against a profit. Debenture interest is a charge against a profit. And dividend on equity shares also is an appropriation of profit that cannot be claimed as an expense by the company for tax purposes. So if you look at interest saves the tax, that's why in financial management you would have learned I into 1 minus T. Why? Because interest is saving the tax. So you would have learned this in financial management. That is about interest. Okay. In case of preference shareholders, they will get only when there is a profit. But it is compulsory. Payment of interest is compulsory. Whether you are having surplus profits or not, whether you are earning money or not, the company must pay the dividend. Okay. When there is a profit, or free reserve, and if the directors recommend. Okay, just because the company is earning profit, equity shareholders will not get the dividend, but they will get the dividend only when it is recommended by the directors. If directors are not recommending anything, then dividend will not be paid to them. So this is the properties of debenture, preference share, and equity share. Okay, sometimes an MCQ can be asked, which of the following is compulsory or mandatory? Dividend on preference shares, dividend on equity shares, interest on debentures, none of these or all of these, like that they can give the options. So interest becomes compulsory. When there is a liquidation, what is order of paying? First, you should settle the debenture holders. Then preference shareholders, then equity shareholders. Equity shareholders are the ultimate risk takers or members of the company. They will appear in the register of members. Okay, So equity shareholders will get the money at the end, and of course, the people who have given the loan will get the money first. So debentures are a kind of a loan that is taken by the company. Okay, now, in the examination question, they can ask you about issue of debentures. Issue of debentures. Okay, when debentures are issued, what is the entry? Bank account debtor to debenture. This is face value. This is the amount received from the debenture holder. Okay, if you collect equal to the face value, this is the entry. Suppose if you issue the debentures at premium, that will be called as what? Securities premium. If issued at premium, can debentures be issued at discount? Can debentures be issued at discount? Shares cannot be issued at discount, but can debentures be issued? Yes. If debentures are issued at discount, sometimes apart from the face value, the company might promise a premium on redemption. The company might promise a premium on redemption. If there is such promise, it will be called as premium on redemption. So why are you crediting? It is an additional liability. So this is not going to be paid now. This will be paid after 5 years, 6 years. But why are you creating? Prudence, conservatism, okay, or full disclosure you have to give. So that's why premium on redemption is an additional liability that should also be recorded. This extra liability, apart from debenture, let us assume debenture face value is 1 lakh, and you are promising to pay at 25,000 premium. This premium on redemption promised, is it a loss or gain for the company? Is it a loss or gain for the company? It's a loss. So this will be called as a loss on issue of debenture. Okay, always the premium on redemption will be equal to loss on issue. So if debentures are issued at a discount, there are two losses. One is discount on issue of debenture, another one is what? Loss on issue of debenture. There are two things. Okay, one is discount on issue of debenture, another one is what? Loss on issue of debenture. Okay, let me to give a case. Let's assume 12% debentures, rupees 5 lakhs, were issued at premium of 20%. What is the journal entry you will pass for this? No premium on redemption, no discount on issue. Bank account debtor to debentures account to securities premium account. So this will be like debentures will be always credited at face value 5 lakhs. Premium is 20% means 1 lakh. So total amount debited will be 6 lakhs. Okay. What will happen? These debentures are issued at discount. Will debit discount on issue. Sometimes they may ask you, they cannot ask a journal entry. They will ask you to find out the total loss. Let's assume 15%. This 15% represents interest to be paid. Five 15% debentures are issued at a discount of 5% and redeemable at a premium of 15%. What is the entry you will be passing? There is no premium. There is no premium on issue. First base entry will be bank account debtor. Okay, let us assume the value is 10 lakhs. Bank account debtor, will you collect 10 lakhs? Debenture values 10 lakhs. Debenture values 10 lakhs. But there is a discount of 5%, which means 5 lakhs will be the discount, or 50,000 will be the discount. So you will be collecting how much? 9,50,000 only. Okay. Then apart from that, we promised a premium on redemption. How much percentage? 15%. That will be 1,50,000. That will be equal to loss on redemption. That will be equal to loss on issue of debenture. Okay. So always this premium paid is equal to the loss on issue of debenture. So base entry is bank account data or discount account data to debenture. Okay. The premium on redemption is an additional liability, which is equal to what? Loss on issue of debenture. Now, will this be tested in exam? Yes, this will be tested in exam, but not in journal entry form. They will ask you how much of loss you will transfer to P&L account. If A, all debentures are redeemed at the end of fourth year. Simple. What is the discount given? 50,000. What is the loss on issue of debenture? 1,50,000. What is the total loss? 2 lakhs. This total loss will be written off over a period of 4 years. So how much will be? Rupees 50,000 per annum. Okay. If all the debentures are going to be redeemed after 4 years, okay, we'll write off the loss. This 2 lakhs of loss is not for 1 year. This is for how many years? 4 years. So this will be taken to P&L account over a period of how many years? 4 years. The question can be like this. Or the question can be, if debentures are redeemed in 4 equal installments, it is like debenture value is 10 lakhs. You are going to repay 2 lakhs, 250,000, 2,50,000 like that. So if you look at for the year, amount outstanding, first year, second year, third year, fourth year. Outstanding amount for the first year will be 10 lakhs because you are going to start to repay only from the end of first year. Second year, it will be 2,50,000 repaid, so 7,50,000 outstanding. Then 5 lakhs outstanding. Then last year, 2,50,000 outstanding. Fifth year beginning, it will become zero. If you look at the ratio, of funds outstanding, it will be 4:3:2:1 ratio. So total is 10. Ratio total is 10. In this proportion, this loss will be written off. What is the loss? Total loss, 2 lakhs. This total loss will be written off in this proportion. So this will be like 2 lakhs into 4/10. Then 3/10, 2/10, 1/10 like that. Okay. So this case is a most important case for examination, where they will ask you how much of discount will be written off for the third year, or how much of total loss will be written off for the third year. The question is about total loss. Okay. The question is about total loss. If they ask you specifically discount, consider only the discount. Here the question is about how much of loss to be written off, 2 lakhs over a period of 4 years. Okay. If it is redeemed at once, equal amount. If it is redeemed like this in installments, work out the ratio of loan outstanding. Then that is debentures outstanding. Then in that proportion, the discount will be written off. In that proportion, the discount will be written off. Discount and the loss on issue will be written off in the P&L account. Okay, this is one of the most important questions for examination point of view. I've given this as a question. Go to question number 23. This one. A Limited issued 10% debentures of 100 each at a discount of 10%, redeemable at a premium of 10%. Debentures are redeemed at the end of fourth year. Debentures are redeemed in 5 equal annual installments. No need to pass a journal entry. What is the discount given? 1000 debentures into 100 rupees face value into 10%. What is the premium on redemption? Same. What is the total loss? 20,000. The total loss is 20,000. If all debentures thousand into 100 into 10%. Okay, if all debentures are redeemed at the end of 4th year, then it will be same like last problem. This 20,000 will be written off over 4th year, 4 years time. So this will be rupees 5,000 per annum. B, if debentures are redeemed in 5 equal installments, then you have to work out the ratio. The ratio will be in the reverse order. You can work out. The ratio will be in the reverse order. $20,000 into 5 by 15. The moment fractional answer comes, then we will have a doubt about our answer. But this is a correct answer. This is if debentures are redeemed in 5 equal installments. If we want to work out, we are going to redeem it in 5 equal installments, which means 4,000 will be redeemed. 20,000 by 5 will be 4,000. So 20,000 outstanding, 16,000, 12,000, 8,000, then 4,000, like that. The amount outstanding will be there. Otherwise, directly you can take the ratio in the reverse order of the year. Done. So this is a most important objective type question in debentures, especially this part B. They may ask you what is amount to be written off for the 4th year, or for the 5th year, or for the 3rd year, or they may ask everything. If they ask everything, they will give you options A, B, C, D, like that. They may give you options where for 4 years the amount that will be given, so you have to choose the amount properly. But I hope it will be tested only for one particular year, so that if the students are not strong in the concept, they'll do a mistake. Am I clear to you all? Shall we proceed? Yeah, both the workings I will share. Yesterday's working as well as today's working I will share. Next. See, for buyback of equity shares, there are a lot of restrictions, which we are going to see after the debenture chapter. Sir, why did you start debentures? When we start with the buyback and go for debenture, we will have no mood to study debenture. That's why I started with the debenture. With a fresh mind, we'll be able to learn. Okay. So in the examination, they will ask you buyback of debentures in the open market. Nothing but the company purchasing its own debenture. A company purchasing its own debenture. So why are you doing this? Why are we purchasing our own debentures? Simple. We have surplus money, idle money which is there in the current account. When you keep debentures, you have to keep paying interest. Instead of that, you can buy and cancel. You can buy and cancel so that you can avoid the interest obligation. So it can be purchased for cancellation. This can be purchased for cancellation, or this can be purchased as investment. This is not allowed for equity shares. Equity shares, if you buy, you must cancel immediately. But debentures can be purchased and cancelled immediately, or it can be held as an investment, like your own debentures, investment in your own debentures. What is the journal entry we'll pass? Debentures account will be debited because we are buying back at face value. Okay. Then suppose if interest was paid 3 months back, and if you are purchasing today, you in the sense company, okay, 3 months back we paid interest, today we are purchasing, means we have to pay interest on debentures. No conditions for buyback. For debentures, the company law should be happy. The company law should be happy for repaying the loan. Companies repaying loan. So this is for the intervening period. That is, if debentures interest was paid in June, okay, now you are purchasing it. So probably 3 months interest, 4 months interest, like that you have to pay to bank account. So bank account is nothing but amount paid. Okay, then profit on cancellation will be transferred to capital reserve. I'll come to the B part later. Let us concentrate on A part. Debentures account data are face value. Debenture interest account data are for the delayed period. Suppose if you would have paid interest in, let us assume June month. Now we are in November end. So June, July, August, June is over. Okay, July, August, September, October, November. 5 months you have to pay the interest and buy it. To bank account, the amount paid. To capital reserve will be profit on cancellation. So is there a chance of loss on cancellation? In the past examination, they have not asked with loss on cancellation, and I hope company will cancel it only when there is a minor profit. With the loss, they will not do cancellation. Okay, no securities premium involved here. No securities premium involved here. We are buying back from, we are not redeeming. Please understand, we are not redeeming. We are buying back from the open market. And how to determine the amount paid? This can be X interest, which means payment or quote does not include interest. So add interest and pay. For example, if I quote 40,000 X interest, then I will add interest and pay. Okay, like that. That is called as X interest. This can be cum interest quotation. Okay, quote already includes interest. Quote means amount quoted. That means no separate payment need to be made for interest. For example, if I quote 40,000 cum interest to buy the debenture, if you agree for this, okay, I will pay you only 40,000. This includes interest. This includes what? Interest also. So the debenture can be purchased for cancellation, or this can be purchased as investment. If it is purchased for cancellation, journal entry will be debentures account data, interest account data to bank for the amount paid, then profit on cancellation. So in this, how it can be tested? They can ask a journal entry. Okay, if it is a paper pen examination, in online examination, they can ask you, what is the debenture interest payable? What is the amount payable? What is the profit on cancellation? Like that, they can split and ask the question. Okay, we'll see a problem. Go to this. Or go through this entry once again, then we'll go to the problem. Shall we? On 1st April 2020, X Limited had 10,000 15% debentures of 100 each. It pays interest on which date? It pays interest on 30th June and 31st December every year. Okay, look at interest is paid on 30th June and 31st December every year. The company purchased debentures for cancellation. So on 1st June, they are purchasing at the rate of 99x interest. On 1st October, they are paying 99.5 cum interest. On 1st March purchase, is it X interest or cum interest not specified? We have to assume. They ask you to calculate interest and profit or loss for purchase in each case. So probably like 2 marks for each question. So three questions. You have to calculate interest and the profit and loss for the 3 purchases. So 6 marks, this can be tested in exam. Look at when debenture interest is paid, 30th June and 31st December. Okay. Journal entry is going to be same. Journal entry is going to be the same. Only thing is that the interest calculation will be different. When are we purchasing first? 1st June 2020. Debentures account at our face value. How many debentures we are purchasing? 1000 debentures. Face value is 100 rupees. 1000 into 100. 1000 into 100, 1 lakh. Debenture interest account data. See, we are on 1st June 2020. When interest would have been paid previously? When interest would have been paid previously or prior to 1st June 2020, we would have got interest on 31st December 2019. Okay, prior to June, they would have paid interest in June month. That is December month. Prior to June, December month. How many months? 5 months. So debenture interest will be 1 lakh into, it is how much percentage debentures? 15% debentures. 15% debentures into 5 by 12 for 5 months. What is the debenture interest account data? You're able to see the screen, right? There is no issue in seeing the screen, right? Okay. 6,250. Amount paid will be, is it X interest or cum interest? X interest. So this will be 1000 into 99. Then you have to add the interest and pay. How much? So profit on cancellation is the balancing. You need not pass a journal entry also. Okay, you can just do it like a computer calculator calculations. You can do this. Or rough work, you can do this. Debentures plus interest minus amount paid will give us what? Profit on cancellation. This is on 1st June 2020. Again, when are we purchasing? Again, when are we purchasing? 1st October 2020. Entries are going to be same. Debenture interest account data, even for the next one, entries are going to be same. Okay, what is the face value of debentures purchased? How many debentures we are purchasing? 500 debentures into 100. Face values 50,000. Interest, we are purchasing on 1st October. Prior to this, when interest would have been paid? 30th June. So how many months later? July, August, September. How many months? 3 months interest you have to pay. Or that will be included. So this will be 50,000 into 15% into 3 by 12. 1875. 1875. Amount paid, it is cum interest, right? Amount paid is cum interest. So how much you have to pay? Earlier we added interest and paid. Now how much you need to pay? 500 into 99.5, that's all. Cum interest. How much you have to pay? Balance will be profit on cancellation. So if it is cum interest, don't add interest and pay. This will be transferred to capital reserve. Again, when are we purchasing? When are we purchasing next? 1st March. So we are purchasing on 1st March 2021. How many debentures we are purchasing? 100 debentures, face value 100, 10,000. Debenture interest 10,000 into 15%. For how many months? Prior to 1st March, they would have paid interest on December end. So 2 months. 2 months. Interest is paid by the company on 30th June and 31st December each year. We are purchasing on 1st March 2021. So 2 months. $250, right? Amount paid, they have not specified in the problem. Is it X interest or cum interest? They have not specified in the problem. What to do? 100 into 100. 100 into 100. They have not specified. Is it X interest or cum interest? If nothing is specified, it is X interest. If nothing is specified, it is X interest. Payment excludes interest. You would add and pay the interest. So this will be 10,250. No profit or loss on cancellation. So if the quotation or if the problem is silent, take that as X interest. Take that as X interest. So when debentures are purchased and cancelled, these are the journal entries we pass. Okay, debentures account debtor, debenture interest account debtor to bank account for the amount paid. Balancing figure goes to profit on cancellation. Two things that you have to work out, or three things you have to mind. One is debentures always debited or credited at face value. There is a loan or nominal value of loan. When you issue debentures also, always debentures are recorded at which value? Face value. Same like shares. Now here, debenture interest should be calculated only for the intervening period. That is, see the previous payment of interest till the date of purchase. Then amount paid, if it is X interest, add the interest and pay. If the problem is silent also, take it as which one? X interest. Okay. Then balancing figure, of course, becomes profit on cancellation. This is purchased for cancellation. Purchased for cancellation. Next. Purchased as investment. Okay, whenever you are purchasing as investment, you will debit investment account debtor. Okay, but since it is our own debentures, we will not debit investment. We will put own debentures account debtor. This will be the balancing figure. Debenture interest account debtor, same as previous one. Amount paid also same as previous one. Okay, instead of debiting, we are not going to cancel this. We are going to debit own debentures as an investment. It's going to be held as what? Investment. Debenture interest, same like the previous case you have to work out where, okay, debenture interest will be paid from the previous date of payment till the date of purchase. To bank, amount paid is going to be same. Okay. Then this is when debentures are purchased. When debentures are purchased. Then when debentures are cancelled, debentures are cancelled, debentures account debtor, face value to own debentures account. This is nothing but the amount invested, and the profit will go to capital reserve. Profit will go to which one? Capital reserve. So when debentures are purchased, you pass the entry, and when debentures are cancelled also, you pass the entry. Okay. So when debentures are cancelled only, that profit is transferred to which one? Capital reserve. This is when debentures are purchased as which one? Investment. I am adding an if case in this problem. In question number 22, if debentures are purchased as investment and all own debentures were cancelled on 31st March 2021, pass journal entry. They cannot ask you journal entry for this, or they will not do this. Okay, instead they will ask the previous method only. So when are we purchasing first? On 1st June 2020. On 1st June 2020, all the things are same. All the things are same. Instead of debentures account, we are going to debit which one? Own debentures account. Own debentures account debtor. Profit on cancellation will not come. Profit on cancellation will not come now. It will come only when debentures are cancelled. Only when debentures are cancelled. So own debenture will be taken as a balancing figure. This much we paid. This is the interest included. So this will be 1,05,250 minus 6,250. This represents amount paid for debenture excluding interest. Okay, there is nothing but 1,000 into 99. This is the amount invested or paid for debenture. Total amount minus interest. Same way, even 1st October also. This will not be 50,000. No profit on cancellation will come when debentures are purchased as investment at the time of investing the money. Only when debentures are cancelled, that profit on cancellation will come. So here, how much? This much we paid, that includes interest 1875. So this is the own debentures account. Here also, this will be a balancing figure. This will always a balancing figure. So bank account amount paid is 10,250. This will be a balancing figure. Then on 31st March 2021, when own debentures are cancelled, what is the journal entry we need to give? 15% debentures account debtor to own debentures account. So totally how many debentures? Totally how many debentures? 1,000 plus 500 plus 100. Totally how many debentures? 1,600 debentures into 100. To own debentures, add up whatever is credited. This is 99,000 debited. Okay. This one plus this one. Balance will go to capital reserve. Profit on cancellation will be transferred to capital reserve. 1,60,000 minus this one. $3,125. Okay, if you add up the previous capital reserves transferred, the same answer you will be getting. Okay, this is about debentures purchased and cancelled immediately versus debentures purchased and held as investment. Okay, so take a breath or take a break for 5 minutes. Then we'll start with sinking fund method of redemption. We'll start with sinking fund method of redemption after 5 minutes. Yeah, this working I will share, including yesterday's working I will share. 5 minutes, let us take a break and continue. Okay, this cancellation entry. Whenever you are buying, you are debiting to own debentures account. This is like an investment account. Yes, boss, Prasad. DJ to solrேன். Okay. Debentures are cancelled against own debentures. Debentures are cancelled against own debentures. Okay. So debentures account data are because the liability is cancelled. The liability is cancelled. Okay. So debit the liability which is cancelled. Totally 1,600 debentures into 100, 1,60,000. To own debentures, to own debentures, whatever is debited so far, add and credit it. The balance goes to capital reserve. The balance goes to capital reserve. Shall we? Okay. Now, sinking fund method of redemption, they cannot ask a journal entry and prepare a ledger account. You cannot do that. Okay. It is simple and easy for you. It's very, very simple and easy for you. Sinking fund method. Okay. What is sinking fund? The fund that is created for redeeming debentures. The fund that is created for redeeming debentures. Whatever is the fund that will be invested. Whatever is the fund that will be invested in government securities, etc. and all over a period of 3 or 4 years. Over a period of 3 or 4 years. So when debentures are due for redemption, you will sell the investments and repay the debenture. Okay, I'll repeat. Let me do break and give it in a simple sentence. Let's assume your company has issued 5,000 crores of debentures, 5,000 crores of obligation. This obligation has to be paid after 5 years. This obligation has to be paid after 5 years. Suddenly, after 5 years, where will you go for 5,000 crores? Because the money 5,000 crores will not be there in the bank. It will be there in the form of land, plant, machinery, working capital, things like that. So suddenly, when you have to get 5,000 crores, it is not possible. So what happens is, from profit, every year you create a fund called a sinking fund. Okay, you set aside a fund called as which one? Sinking fund. That money will be invested. That fund will be what? Invested. Over a period of 3 or 4 years or 5 years, you will keep investing. Then in the last year, you will sell the investment. You will sell the investments and redeem the debentures. It's like, let's assume annually 900 crores is invested. So first year 900, second year 900, third year 900, fourth year 900, fifth year like that. You will keep appropriating. So 900 into 4 or 5, it will give us 4,500 crores. That interest, you see, when you invest, you will get interest also. Along with that, it will become 5,000 crores or plus 5,000 crores. So this is the concept behind sinking fund. So annual appropriation is done and the amount is invested. Then how much? Annual appropriation. Simple. How much to be transferred to sinking fund from profit and loss? It depends on what is the amount required for redemption. This may be face value plus premium on redemption. Okay, this multiplied with the present value factor. This depends on interest, number of years. Okay, what is the rate of interest and how many years? Based on that, this present value factor will be there. Okay, so how much you will transfer to sinking fund depends on what is the amount required for redemption, the face value plus premium on redemption that is promised into the present value factor. Okay, so this can be tested in a separate question. Now let us come to question number 21. On 1st April 2016, A Limited issued 10,000 12% debentures of 100 each. Read the question full, then we will solve. Read the question completely, then we'll work out. shall we? So if you look at 10,000 debentures of 100 each, which means we want 10 lakhs. We want 10 lakhs. It is redeemable at a premium of 10%, means we need totally 11 lakhs. If you look at the face value redeemed, 10,000 debentures of 100 each. 10,000 debentures of 100 each. 1 minute. Sorry, yeah. 10,000 debentures of 100 each, face value 10 lakhs, plus premium on redemption, 10% will be 1 lakh. This into present value factor. What is the present value factor? 0.180975. This much has to be invested. This much has to not invested. This is the amount to be transferred from P&L appropriation to sinking fund account. Okay. And the examination, since ledgers cannot be tested, it is easy for us to work out. So this is annual appropriation. Okay. Now we'll have a sinking fund and we will have sinking fund investment. Nothing but debenture redemption fund and debenture redemption fund investment. Okay. No need of preparing an account. First year, how much will be appropriated? 19,000, this one. And that will be invested. First year investment will be this much. Then will you get any interest in the first year? Will you get any interest in the first year? No, first year we will not get any interest because we are starting to invest from the end of first year, So second year, we'll be getting an interest. At the rate of 5%. ROI is given as 5%. So this into 5% we'll be getting. And first year from P&L account, appropriation will be same. Every year it is going to be same. Now both will be invested. Second year investment will be interest for the second year plus appropriation. Both will be invested. Interest plus appropriation. Both will be invested. So closing balance for the second year will be interest. Why are you adding with the fund? Because it will not be transferred to P&L account. It's a specific investment made. So this will be the closing balance for the second year.
Sir, doubt, sir.
Yes, please.
Sir, question is not mentioned like first year, at the end of the first year. How we have to assume on?
Always investments or appropriations are done at the end of the first year. For example, we know we calculate profit at the end of the year. Otherwise, let's assume on 1st April 2020 debentures were issued. Okay, from the end of the first year only, you will start appropriating and investing the money. Because today we got a loan. From the first year, we'll start creating it. Then, for third year, see, it becomes so simple, Earlier, debenture was a tough topic. Now it becomes an easy one. Third year interest will be received at the rate of 5%. On which balance? On the total balance invested. And appropriation. Appropriation means amount transferred from P&L account. That will be same every year. Then third year investment. Will be that year interest plus appropriation. So this year interest plus appropriation. Both invest in the third year. Now third year closing balance. Third year closing balance will be this plus this plus opening balance also. Opening balance, second year closing balance will be third year opening balance. That plus interest plus appropriation. So this was our opening balance, plus we made investment this much. So if you look at the closing balance in the fund will be equal to the closing balance in investment always, because whatever is there in the fund only is invested, and whatever is there in the investment should be there in the fund account. Then we are moving to fourth year. Interest at the rate of 5%. Third year closing balance is fourth year opening balance on this 5%. Then this year appropriation. Same appropriation will come for this year also. Then both will be invested. Fourth year investment, again interest plus appropriation. This one, interest we collected plus fourth year the money taken from P&L account, both will be invested. Then fourth year closing balance. Opening balance plus interest plus appropriation made in the current year will give us closing balance. We'll get the same. This is fourth year closing balance. Okay, we are moving to the last year, fifth year. Fifth year, will you get interest? Yes, investment was made till the end of fourth year. So interest will be received on the investment made. Will you take the money from profit and loss account? Will you take the money from profit and loss account? Yes, you will take the money from profit and loss account. That will be same. Fifth year also you will take the money from P&L account. Fifth year, will you invest? Fifth year, will you invest? Debentures are redeemable at the end of fifth year. Actually, there is a mistake in this. This is 8,50,000. This is not 4,50,000. This is 8,50,000. 8,50,000. So, will you make investment in the fifth year? Debentures are redeemable at the end of fifth year. Debentures are redeemable at the end of fifth year. So, will you make investment? No. Once again, I repeat. First year, we take the money from P&L account, and first year that money is invested. Because there will be no interest in the first year, no income in the first year, because investment is just made today at the end of first year. Second year, on the first year amount invested 5%. 5%. Then appropriation, both are invested. Then second year closing balance becomes third year opening balance on that 5% interest plus appropriation that is invested. Fourth year, the third year closing balance becomes fourth year opening balance, that into 5% plus appropriation that is invested. Fifth year also you will get interest, you will take the money from profit and loss account, but you will not invest. You will not invest. Fifth year, investments are going to be sold. It's given in the problem. It is sold for, yeah, I changed it, 8,50,000. It is sold for 8,50,000. Now, is there a profit or loss? Is there a profit or loss? Is there a profit or loss? Loss. Loss. Value. This is a value. Okay. So, loss on sale. This much minus 8,50,000. This is a loss on sale of investment. Loss on sale of investment. This is in which year? Fifth year. But fund is not closed. Fund is not closed. If you look at the closing balance, if you look at the closing balance, this is a closing balance. This is a closing balance in fund. Balance in fund at the end of 5th year. The fund is not closed. Only the investments are sold as of now. Now, what to do, sir? Simple. Against the fund, the loss on sale of investment will be written off. What is the loss on sale of investment? What is the loss on sale of investment? This amount. And if you look at debentures are having a face value of 10 lakhs. They are redeemed at a premium of 10%. They are redeemed at a premium of 10% means 1 lakh. So totally how much you have to pay? 11 lakhs we have to pay. $11 lakhs has to be paid to the debenture holders. Okay. So when there is a sinking fund, this premium on redemption is a loss. That will be written off. Premium on redemption will be written off against a sinking fund. Against which one? Sinking fund. And the balance will be transferred. Balance fund. Now debentures are redeemed. We don't require any fund. Will be transferred to general reserve. It will be transferred to general reserve. From this 11 lakhs, eliminate all these things. Balance will be transferred to general reserve. Okay. If you look at the general reserve transfer would be 1 minute. Let me to complete and I will come to that. 1 minute. 1 minute, Prasad. Okay. So sinking fund is created over 4 years time. 5th year, we get interest. We transfer the money from P&L account, but we don't invest. We sell the investments. So there is a loss on sale of investment that will be charged against which one? Sinking fund. Loss on sale of investment is charged against investment. This is balance of fund at the end of 5th year. 1 minute, Prasad, I'll come to you. At the end of 5th year. Okay. Loss on sale of investment will be adjusted against a sinking fund. Premium on redemption, that loss also will be adjusted. The balance will be transferred to general reserve. Sir, is there a chance to verify the answer? Yes. If you eliminate and see the loss, this will be equal to 10 lakhs. If you eliminate and see, what is the face value of debentures redeemed? 10 lakhs. The amount to be transferred to general reserve should be 10 lakhs. Should have been 10 lakhs. Okay, but since there is a loss on sale of investment, there is a reduction. Suppose if there was no loss on sale of investment, you have transferred 10 lakhs to general reserve. Otherwise, you can check before this premium on redemption and loss, the balance in fund is 11 lakhs. How, sir? We created a sinking fund based on 10 lakhs plus 1 lakh. 10 lakhs plus 1 lakh, 11 lakh only. Maybe the first one we multiplied 11 lakhs into 0.180975. So when you create sinking fund based on 11 lakhs, the balance in sinking fund will be 11 lakhs, which is used for writing off the loss on sale of investment and adjusting which one? Premium on redemption. The balance fund is transferred to general reserve. Yeah, Prasad, now for your question.
Sir, in 5th year itself, we can add like the interest of 42,901. We can add it with the 8,58,000.
No, interest will be received separately. That is an income. It's a capital item. Investment is a capital item. Investment will be accounted separately. You got the cash for this interest separately. Journal entry will be itself bank account data to interest on investment. So that will not affect investment value. But here, why are we adding? Because interest as well as appropriation, both are invested. That's why we are adding. 5th year, interest is accounted separately. That goes to a separate account. Okay, I need to recap. First year, whatever is appropriated is invested. Second year, interest plus appropriation is invested. We get the closing balance. Third year interest will be under second year closing balance or third year opening balance. plus appropriation that is invested. Fourth year also, the interest will be on this amount plus appropriation, both are invested. Okay, fourth year closing balance is this much. Otherwise, this is a fifth year opening balance. Okay, on which you will receive interest, and fifth year also you will appropriate money, but you will not make investment. You will not make what? Investment. And investments are sold for a loss. That loss will be adjusted against a sinking fund. Premium on redemption also will be adjusted against sinking fund, and balance fund will be transferred to general reserve. How to verify your answer? How to verify your answer? Eliminate the loss, you will get exactly 10 lakhs. That 1 rupee is different because of the fractional workings. Otherwise, it should be 10 lakhs. Now, sir, how this question will be tested in exam? They can ask you anything, whatever we worked out. For example, they can ask you question number 1. If they give this, question number 1 will be, what is the annual appropriation? Then they can ask you what is the interest for the first year, or second year, or third year, or fourth year, they can ask you. Or they can ask you what is the closing balance in fund or investment. Second year, third year, fourth year, they can ask you. They can ask you what is the loss on sale of investment. What is the loss on sale of investment? What is the profit or loss on sale of investment? Then after all the transactions are over, how much will be transferred to general reserve? How much will be transferred to general reserve? They can also ask you how much to be paid to debenture holders, like that. Set of 7 or 8 questions can be asked. If this question is asked, it will be for 10 marks. It will be for 10 marks. No need to prepare ledgers. Okay, like in a paper pen examination, you have to prepare sinking fund account, sinking fund investment account, okay, interest account, those things. Now it is only a tabular working or calculation. So this online examination makes December as well as debenture much easier. Even if you prepare in the form of ledger account, same balance will come. This will be like buy P&L account, buy interest, buy P&L account, like that we credit and we'll close. Then next year, buy interest, buy P&L account, like that we'll credit and close. Like that the closing balance will be worked out. Last year, debit side, we will put the loss on sale of investment, then premium on redemption we'll adjust. Then balance will be transferred to general reserve. Yeah, PV factor will be provided. Present value factor will be provided. PV factor, annuity factor, all those things will be provided. So with this, the concept of debentures is over. This is important for a minimum of 5 marks, maximum of 8 marks. For examination point of view, minimum 5 marks, maximum 8 marks, it is important. Those who have learned by descriptive method, especially this debenture concept, or in Bharadwaj classes, we would have prepared ledger accounts. The ledger accounts we are going to do it in, we have done it in statement form. That's all. Okay. So this is for debentures. Next, we will start with buyback. We will start with buyback. Now, many students were asking, suppose if theory question is asked in descriptive type, how to answer this? For example, this can be tested in theory. What are the conditions for buyback? What are the conditions for buyback? Okay, nothing wrong. You can take, do you want a break or shall we continue? If you want a break, I can give it. Otherwise, we can continue. No issues. For me, talking is easy. For you, listening is the difficult one. Continue. Done. Good. Super. Okay, let me take a small coffee break and talk. Yeah, okay. 2 minutes. 2 minutes, I'll join back. 2 minutes. Yeah, we will continue. Suppose if the theory question is asked about conditions for buyback. Why so much of system issue for the past 2 days? I do not know. Okay. If they ask you conditions for buyback, you can just try to key in the main points. Okay. Only fully paid shares. can be bought back. Like this, you can give the points and type. Okay. Like point by point, you can give the answer. Main points alone you have to key in. Only fully paid shares can be bought back. It should be authorized by articles of association. But don't write AOA. Please type articles of association. Number 3. Defunctional companies. Are not allowed to buy back. Okay. Defunct company means the companies which are having some default. They would not have filed returns with ROC, or they would not have filed income tax returns, or they would not have returned the deposits, or loans and dues will be there. So they are called as defunctional companies listed by ROC. Register of companies will list them. Okay, those companies are not allowed to buy back. Then, maximum limit on buyback. 10% of shares with board of directors resolution. If you want to buy more, we can buy up to 25% with a special resolution in shareholders meeting. Okay, so if you want to buy maximum 10% with board of directors resolution and up to 25% with special resolution in the shareholders meeting, you can buy. You cannot buy more than 25% of shares. Amount paid on buyback should not exceed 25% of share capital and free reserves, which means you cannot pay more than 25% of shareholders' funds. After buyback, the debt to equity ratio should not exceed how much? Good, 2:1. The shares bought back should be cancelled within 7 working days. Okay, you cannot keep this as investment. You must cancel it within what? 7 working days. You cannot use a normal bank account. You must open a separate bank account, escrow account, for the purpose of what? Buying back. And the buyback should be completed within 1 year of passing resolution. For example, resolution was passed on 1st February 2020 means the buyback should be completed by 31st January 2021. 1 year the resolution is valid. Okay. Then, after the completion of buyback, the company is not allowed to make fresh issue of equity shares for a period of, this can be tested in MCQ also, for a period of 6 months. For a period of 6 months, you are not allowed to issue. Then necessary returns should be filed with ROC and SEBI. If you are a listed company, you have to file with SEBI. Then face value of shares bought back out of profit should be transferred to CRR. This is same like your redemption of preferentials. Should be transferred to CRR. So each these points, just you type in, that is sufficient. You need not give explanation. Main points alone, they will expect you to key in case of theoretical questions. Okay, if you type this, yeah, this is for 6 marks, even if you have got one finger typing habit, you will be able to do it. Okay, when you are writing, you are expected to write in pages, but when you are keying in a main answer, this is what you have to do. This, every point is an objective type question. This can be tested in objective type questions. Okay. I will give you a question. Okay, journal entry is simple. You are buying back equity share capital account data. The premium that you are paying will be adjusted with securities premium to bank. Just pay the money, that's all. Journal entry cannot be tested anyhow. But in the examination, they can ask you questions about how many shares can be bought back. How many shares can be bought back? Let me give a problem. A Limited had the following on 31st March 2020. Equity share capital 40 lakhs, general reserve 30 lakhs, profit and loss account 10 lakhs, securities premium 20 lakhs. It had 12% debentures, ₹1 crore, bank loan 50 lakhs. It had 9% bonds, 10 lakhs. Current liabilities 3 lakh, 30 lakhs. This is the capital structure of the company. Okay. Fair market value, the market value that you have to pay per share, ₹80. Equity share capital face value is ₹10. Case 1. Calculate the number of shares that can be bought back. And the CRR. This can be tested for 5 marks. For limit for buyback, you have to check all these things. For solving numerical problems, 3 conditions has to be checked. We can buy up to 10% with board of directors resolution and 25% with a special resolution in the shareholders meeting. Amount paid on buyback should not exceed what? 25% of capital and reserves. After buyback, debt to equity ratio should not exceed 2:1. These 3 things you should check for limit on buyback. Now, I will give you 5 minutes of time. Try to work out and give me the answer for buyback. One of the most important questions that can be tested in exam. 5 minutes of time. You just work out and tell. I hope I made to get a correct answer. Okay. Let me to check. Limit 1. Maximum number with special resolution. Let us always go with maximum, then let us decide. 40 lakhs means there will be 4 lakh shares. This into 25% will come to 1 lakh shares. Which means if it is 1 lakh shares bought back, amount paid will be 1 lakh into 80. You have to pay fair market value. You have to pay 80 lakhs. We have to check as per the limit 2. Maximum amount that can be paid is 25% of shareholders' funds. Okay, what is shareholders' funds? Equity share capital plus general reserve plus P&L account even securities premium can be taken. What is the total amount? Is it 1 crore? Yes, 1 crore. So 25% of this amount will be we can spend only 25 lakhs. With rupees 25 lakhs, how many shares possible? With rupees 25 lakhs divided by 80 rupees per share means how many shares possible? 31,250 shares. This is second. Not only this, there is one more condition or there is one more limit. After buyback, debt by equity, maximum allowed. What is debt by equity allowed? 2:1. After buyback, debt to equity allowed is 2:1. We know debt is how much? Debt is nothing but debentures plus bank loan plus bonds. If this is debt, what should be the equity? Equity should be how much? If 1 crore 60 lakhs is equal to 2, equity should be how much? 80 lakhs. Okay. So now we know what is the equity. Equity means shareholders funds. Okay. What is a shareholders funds before buyback? What is the shareholders funds before buyback? This 40 plus 30 plus 10 plus 20. What is the total? 100 lakhs. So what is the surplus available? We have got 1 crore of equity shareholders funds, and after buyback, minimum equity shareholders funds maintained should be 80 lakhs. So surplus is 20 lakhs. So with this surplus 20 lakhs, number of shares that is possible is 20 lakhs divided by 80. 20 lakhs divided by 80, how many shares possible? 25,000 shares possible. So we cannot buy as per other conditions, Can you buy 1 lakh shares? If you buy 1 lakh shares, then you are violating the second condition. If you're buying 31,250 shares, then you will be spending 25 lakhs. But surplus in equity shareholders funds available is, okay, only 20 lakhs. Only 20 lakhs. With 20 lakhs of funds available, per share 80 means we can buy only 25,000 shares. Done? So this can be tested directly for 4 marks. This can be directly tested for 4 marks. CRR amount will be face value of shares bought back. 25,000 shares into 10. 25,000 shares into 10. Face value of shares buyback. There is no fresh issue like preference share, etc. issued for buyback. So 25,000 into 10, 2,50,000 will be transferred to CRR. Any doubt in this? Current liability is not part of your long-term debt. Debt to equity ratio, you'll work out. In financial management, you would have learned how to work out debt to equity ratio. Debt means only long-term borrowed funds, non-current liabilities only, and not current liabilities. Limit 1, maximum number of shares possible with special resolution. Our capital is 40 lakhs divided by per share 10 rupees face value means, okay, there will be 4 lakh shares. Four lakh shares into 25%, 1 lakh shares we can buy amount paid if you buy 1 lakh shares will be 80 lakhs. But as per second condition, we can spend only rupees 25 lakhs. Okay, we can spend only rupees 25 lakhs. With 25 lakhs, we can buy 31,250 shares. So number of shares finally bought back is only 25,000 shares. Now, a tricky question can be tested. In case one, how many shares are bought back? 25,000 shares are bought back. Okay. Calculate CRR we have done. What is CRR? 25,000 shares into 10. 2,50,000 that we have done. In this question, there can be a tricky question based on whatever is given. They can ask you a small additional thing. They can ask you a small additional thing that I will include in case 2. Calculate the number of shares to be bought back and CRR if bonds are 30 lakhs instead of 10 lakhs. I'm just adding an if case. If bonds are 30 lakhs instead of how much? 10 lakhs. Okay. Limit 1 and 2 will be same. Limit 1 and 2 will be same. This is case 2. Okay. Limit 1 and 2 will be same. Limit 3, what is the debt value? What is the debt value? 1 crore plus 50 lakhs plus 30 lakhs. Okay, sorry, let me make a change. If bonds are 50 lakhs. Bonds are 50 lakhs, sorry. Okay, so 1 crore plus 50 lakhs plus bonds are not 10 lakhs, bonds are 50 lakhs. So how much will be the debt? 1 crore plus 50 lakhs plus 50 lakhs. What is the total debt? 2 crores. If 2 crore is debt, we should maintain an equity of 1 crore. We should maintain an equity of 1 crore. So funds before buyback is 1 crore. After buyback also 1 crore required, means surplus is 0. Number of shares bought back. Otherwise, you cannot buy any share. The company cannot buy shares. See, if bonds are 50 lakhs, it will be already 1 crore plus 50 plus bonds 50 lakhs means 2 crore. If 2 crores are debt, 1 crore should be equity. After buyback, you should maintain 1 crore. Before buyback itself, we have got only 1 crore. No surplus funds available, so the company cannot buy back. So if surplus is not available or if there is already a deficit in debt equity ratio, you cannot buy the shares. You cannot buy the shares. Here options would have been given like 40,000 shares, 1 lakh shares, 31,250 shares. None of these or 0 can be given as an option. And in case 1, they can add one more question. What type of resolution required in case 1? Can anyone answer? What type of resolution is required in case 1? Is it Board of Directors resolution or special resolution? Any of these? Yeah, I'm getting many answers like special resolution. That is not required. That is not required. You look at the percentage of shares bought back. We are purchasing only 25,000 shares out of total 4 lakh shares. So how much percentage it comes? 25,000 shares only we are buying back out of total 4 lakh shares. It comes to 6.25%. It comes to 6.25%. Up to 10% we can buy with board resolution. You can pass a special resolution, but you cannot buy more than 25,000. So why are you convening unnecessarily equity shareholders meeting and asking them to come for the meeting? You can pass 25% resolution also, but this company, as per company law, it cannot buy more than 25,000 shares. So we can do it with board resolution. So type of resolution required is board resolution. because look at the final shares that can be purchased. So before the buyback is announced, they will plan how many shares are purchased. Accordingly, they will plan for the resolution. Is it going to be with board resolution, or is it going to be with shareholders meeting and special resolution like that? So here it is, board of directors resolution is sufficient. For case 2, whatever may be the resolution you pass, okay, you cannot buy because there is no surplus funds available. Done? Are you clear? Are you getting a clear concept or understanding from this particular chapter? Good. There's a question. Question number 9. The following assets and liabilities on 31st March 2017 is given. 1 lakh equity shares of 10 each fully paid. Securities premium. I recommend board resolution because the number of shares bought back is only 25,000. We are buying only 25,000 shares. But look at total number of shares. Totally 4 lakh shares are there. Out of that, we are buying only 25,000. If you work out the percentage, it will come to less than 10%. When you are buying less than 10% of shares, then why are you going for unnecessarily general body meeting? Now here the company has decided to buy back 20% of equity shares at a premium of 10 per share. For this purpose, they sold investments and issued 15,000 preference shares of 1 each at par. Amount payable is 60 on application, 40 on allotment. The issue was fully subscribed. The company made a bonus issue of rupees 10. That is at the rate of 1 for every 5 shares held. Okay. They ask you to prepare the balance sheet also. They ask you to prepare what? Balance sheet also. Here we need not decide. Already they decided 20% of shares are going to be bought back. They are going to buy 20% of shares. So number 1, 9, buyback. No need to check any conditions. Number of shares bought back. How many shares are going to be bought back? You've got 1 lakh equity shares into 20%. So 20,000 shares we are going to buy. Okay, what is the journal entry for this? We are selling investment. We are selling investment for how much? 2,30,000. It is 1,80,000. It is sold for 2,30,000. It's a normal journal entry only. Investment value is 1,80,000. We are selling this for 2,30,000. The balance will go to profit and loss account. Profit on sale will go to P&L account. Okay, anyhow, this cannot be tested. Journal entry cannot be tested, but for your understanding, I'm doing 2,30,000 minus 1,80,000. The gain will be transferred to P&L account. Then, and issued 15,000 preference shares of 100 each at par. Bank account debtor to 15% preference share capital. How much? 15,000 into 100. You can take it as 15 lakhs. 15,000 preference shares. How that is possible? It's not 15,000 shares. Please make a change. It is 1,500 shares. 1,500 shares at 100. 1,500 shares at 100. It will be 1,50,000. Then we are buying back the shares. See, application allotment, first call, final call, they are not going to test here. So bank account debtor to 15% preference share capital. The final will be like this. You will pass entry bank to share application, then share application to share capital, then bank to share allotment, then share allotment to share capital, like that. The final effect will be this one. Then we are buying back. Equity share capital account debtor, equity share capital account debtor. Okay, we are paying a premium that can be adjusted with securities premium. Okay, how many shares are buying? 20,000 shares into face value 10, 2 lakhs. But we are paying at a premium of 10, which means 20,000 into 10, excess amount paid will be adjusted with securities premium. We have got sufficient premium, so that can be adjusted, 2 lakhs. To bank, totally we are paying 4 lakhs. Totally we are paying how much? 4 lakhs. This is for the amount paid. Then if you look at here also, what is the face value bought back? What is the face value bought back? 20,000 into 10, 2 lakhs. For this, what is a fresh issue made? Fresh issue of preference shares. What is the face value of preference shares issued? 1,50,000. So here also, we need to create a CRR. We have to create a CRR of how much? 50,000. We need to create a CRR of 50,000. Same like redemption of preference share. From where we will create? From general reserve we can take. General reserve account debtor to CRR. We can create 50,000. We can create 50,000. Once again, I repeat, we are selling investments. The profit is transferred to profit and loss account. We are issuing a fresh share, 1,500 shares. Please make a change in the problem. 1,500 into 100, 1,50,000. Equity shares are redeemed at a premium of 10 or bought back at a premium of 10. So totally we have to pay 4 lakhs. Then general reserve account debtor to CRR. This is a face value of equity share capital bought back. Out of profit. Transfer to CRR. Transfer to CRR. Then after this, they are making a bonus issue. After this, they are making a bonus issue. Now, how many shares were there before buyback? How many shares were there before buyback? 1 lakh shares. Less shares bought back. How many shares are bought back? 20,000 shares are bought back. Number of shares outstanding. That means number of shares present at this time, 80,000. Therefore, bonus issue will be 80,000 into what is the ratio? What is the ratio of bonus issue? One for every 5 shares sold. How much you get? 16,000 shares. So do you remember we used to pass an entry, CRR account debtor. We can take money from CRR, but available is only 50,000. There is no old CRR available. There is no old CRR available. Okay, but we have to pay to bonus for equity shareholders. We have to give 16,000 into 10, 1,60,000. Balance we can take it from general reserve. Balance we can take it from general reserve or securities premium. Okay, general reserve account debtor to bonus for equity shareholders. Then bonus for equity shareholders account debtor to equity share capital. That is 1,60,000. Right? So let me explain once again. The company wants to buy 20,000 shares for which they are selling the investment and the amount is transferred to P&L account. And they are making a fresh issue of preference shares for 1,50,000. Then equity share capital account debtor face value bought back 2 lakhs. We are paying a premium of 10. That will be adjusted with securities premium. To bank is 4 lakhs. General reserve account debtor to CRR. That equity shares face value bought back transferred to CRR. Then bonus issue will be, we had 1 lakh shares out of this 20,000 bought back. 80,000 shares are there into 1 by 5. 16,000 shares we need to issue bonus issue. So we need 1,60,000. Out of this, 50,000 is taken from CRR. Balance is taken from general reserve. Then bonus for equity shareholders to equity share capital is 1,60,000. Now here, prepare a balance sheet. Be happy that you are not writing a full format one. So you have to just write share capital with workings. You can directly do it. How many shares were there? We had 1 lakh shares. In that 20,000 shares are bought back, and we had made a bonus issue of 16,000 shares. Okay, opening balance minus buyback plus bonus. This into 10 rupees. How much it comes? 9,60,000. Then this is equity share capital. Preference share capital, we made a fresh issue. What is the fresh issue made for preference share capital? 1,50,000. Reserves and surplus, securities premium. We had 3,50,000. In that, premium on buyback adjusted is 2 lakhs. Balance 2 lakhs will continue. Then, disclaimer again, this is not for paper pen examination. This is only for online examination, where they cannot ask you to type the full balance sheet. They will ask you the balance sheet total only. General reserve. We had 3,10,000. Okay. Minus for CRR, we have taken 50,000. Minus for bonus issue. Minus for bonus issue, we have taken 1,50,000. So what is the balance? 1,10,000. Profit and loss account. What is a P&L account? 1,10,000 plus profit on sale of investment. 50,000. So you get 1,60,000. Yeah, thank you. 9,60,000 plus 1,50,000 will give us share capital. Reserves and surplus will be these three amounts. CRR will not come. We made a bonus issue that will not come. Then debentures will continue the same. How much? What is the debentures? 7,50,000. Current liabilities, creditors. Same amount, no change in the amount. 5 lakhs. If you are confident in answering with the liability side, you can do this. This is the total of liability side. Assets. What will come in assets? This one. Non-current assets. Fixed assets. Plant, property and equipment. Okay. So what is the plant, property and equipment? This 13,50,000 plus 2,40,000. I hope there is no problem from my end. Screen is working from my end well. Is there an issue? I hope the screen is clear from my end, or there is no issue. Current assets. Current assets. Investments are sold, it will not count. Stock 7,20,000. Debtors. Debtors how much? 2,30,000. Bank balance. Opening balance was 3 lakhs plus sale of investment. We sold investment for how much? 2,30,000. And fresh issue. Fresh issue we made for 1,50,000 minus buyback. We spent 2 lakhs. What is the amount? Net amount you are getting. So buyback we spent how much? 4 lakhs. Sorry. What is the net amount you are getting? Two lakh 80,000. This is not telling. Where the I mean, where did I make my mistake? You tell me. There's a numbering error or number error only. General reserve 3,10,000 general reserve that is there. CRR we created 50,000, and for bonus issue, how much we utilized for bonus issue? 1,10,000. Yes, here this is a mistake. Like this, if there is one mistake in the exam, you can identify, but the balance will be 1,60,000. How it tallies, I hope. Why? 1,50,000. Once again, share capital old plus minus buyback plus bonus 9,60,000. Preference share capital fresh issue. Reserves and surplus, securities premium, then general reserve. After adjusting CRR and bonus, then P&L account 1,10,000 plus profit on sale of investment, debentures 7,50,000, creditors are 5 lakhs. Fixed assets are plant and machinery and furniture, stock same, debtors are same. Bank balance is based on collection and payment. Okay, sale of investment, we collected the money. Fresh issue, we collected the money, and buyback, we spent 4 lakhs, so 2,80,000. So 28,20,000 is the total. The one thing is, I don't see the solution and work out this problem, so all these things arises. So I'm also like a student, I can work out and come with PowerPoint presentation, but that will be making me all the more sleep. So either the student or the faculty should be awake in the class. So that's why. So they can ask any question from this. They can ask you what is a bonus issue, or they can ask you what is the money paid on buyback, or they can ask you what is the shareholders funds in the liability side, share capital plus resource, the liability side, or they can ask you total of liabilities, or they can ask you the closing balance in bank. They can ask you what? Closing balance in bank when this question is tested in the exam. Done. Any particular doubt, please ask me. You can unmute and ask, or you can leave a chat message also. Done. Weightage of 5 buyback and preference shares put together, it is important for 8 marks. CRR deduction. From general reserve, we created a CRR of 50,000 and made a bonus issue of 1,10,000. Then check the entry. General reserve account data to CRR. 50,000 we transferred. And the bonus issue, for the purpose of bonus issue, we have taken 1,10,000 from general reserve. No, you won't get such problems, don't worry. Equations method problem and all will not be here, don't worry. Okay, this is asked in the exam. Okay, they cannot anyhow ask a journal entry. They can ask you probably question number 1. What is a CRR created? Sinking fund method, debentures you're asking for. Okay, that is nothing but the face value redeemed plus premium into the annuity factor that I worked out. Anyway, I'm going to share the recording. You can just go through that. This one. Face value plus premium on redemption into the present value factor. Okay, if this buyback question is asked in the exam, okay, they will ask you to calculate what is the amount paid on buyback, what is the CRR to be created, what is the total number of bonus issue to be made, or how many shares or what is the value. They can ask this. Then they can ask you to show or calculate what is the share capital for balance sheet. Or if they ask you shareholders funds, it is share capital plus reserves and surplus. They can also ask you what is the bank balance for balance sheet or what is the total of the balance sheet, like that they can ask you. Done. Now, we will have a 20 minutes breakfast break. After this, we will continue with this particular bonus issue. Okay. Have you tried this problem? Bonus issue. We are making a final call on 1,80,000 equity shares and making it fully paid up. Now we have got 1,80,000 shares of 10 each. 1,80,000 shares of 10 each after the final call. Okay. Then the company decided to capitalize its reserves for bonus issue. Securities premium includes 50,000 includes 20,000 shares issued to vendor for purchase of special machinery. So, bonus issue. Which question number? It is a question number 10. Okay. So, securities premium. Out of 50,000, we cannot use the securities premium not realized in cash. So we can use only 30,000. We can use only 30,000. Then, what is the next one? Capital reserve includes there is a profit on exchange of plant and machinery that is not realized in cash. Capital reserve not realized in cash. Out of 1,50,000, we cannot use 60,000. We can use only 90,000. Then we can use general reserve. No issues. We can use general reserve to the extent of 2,40,000. Profit and loss account, we can use 3 lakhs. But before that, is there any restriction? We ask you to pass journal entry. Okay. 1 share for every 3 shares held. 1 share for every 3 shares held. So bonus issue 1,80,000 into 1 by 3. So we have to issue how many shares? 60,000 shares. So which means rupees 6 lakhs we need. So from where we can take securities premium we can use to the extent of 30,000. Then capital reserve we can use to the extent of 90,000. General reserve we can use to the extent of 2,40,000. For the balance we use P&L account. In the exam they can ask you how much of money is taken from which account. Okay, 6 lakhs minus 3 lakhs minus 90,000. Sorry, 30,000 minus this one. 30,000. From P&L account for the balance we use. We've got a balance of 3 lakhs, but we are using only 2,40,000. Journal entry is simple. Securities premium account data, capital reserve account data, general reserve account data, P&L account data to bonus for equity shareholders 6 lakhs. Debit all these reserves to bonus for equity shareholders 6 lakhs. Then bonus for equity shareholders account data to equity share capital 6 lakhs. Like that, we can give a journal entry. Okay, in online examination, they cannot ask a journal entry. Okay, they can ask you maximum which reserve, how much is used, or what is the value of bonus issue. That's what they can ask you. Balance sheet after bonus issue, authorized capital will not count. Preference share capital will continue. Equity share capital will be 18,000 into 10. 18,000 into 10, 80 lakhs. So plus this bonus issue 6 lakhs will come. Then general reserve is used, capital reserve is used, securities premium is used. Of course, that remaining 20 and 60 will come, P&L account will come. They cannot ask this. They can ask only this much. Like what is the bonus issue to be made to equity share? Question number 11 you can go through. Issued capital is 10 crore shares of 10 each. Value is given in lakhs. Okay. The company is making a final call of 2 rupees per share. They're making a bonus issue of 2 shares for every 5 shares held. For this purpose, capital reserve to the maximum possible extent they want to use. Capital reserve, they want to use the maximum possible extent. So this also you can work out. What is the bonus issue? 10 crore shares into 10 crore shares into 10 crores means how much lakhs? I'm very weak in maths. Divided by 10. It will give us 10 crore shares. 10 crore shares. Yes, please. Please keep yourself in mute. Coming back, so 10 crore shares is the thing. Bonus issue will be how many shares? 10 crore into what is the ratio of bonus issue? 2 for every 5 shares held. So you have to give 4 crore shares. So when you have to convert rupees in lakhs into 10 rupees we need. So 4,000 lakhs. Rupees is given in lakhs only, right? So for this purpose, we can use CRR. We can use CRR, capital reserve. We ask you to use capital reserve to the maximum 485 lakhs we are using. CRR will be used for this purpose, 1,000 lakhs. And then securities premium, 2,000 lakhs. If nothing is specified, we can use it. Balance, we can take it from P&L account. Balance, take it from P&L account. So 4,000 minus 485 minus 1,000 minus 2,000. So much? 515 can be taken from P&L account. 515 can be taken from P&L account. Hi, boss. Good morning. For 5-10 minutes. Okay, this is about the balance that should be used from P&L account. Journal entry will be simple. Debit all the reserve to bonus for equity shareholders. Then bonus for equity shareholders accounted or to equity share capital. Okay. Now, for the evening session, there's a small urgent meeting. So we go with evening session for final accounts. Please go through the format of P&L account, P&L appropriation account. It can be from any textbook. And the format of balance sheet. Please go through them alone for about 20-30 minutes. And especially minimum transfer to be made to reserves. Like when dividend is declared, we'll transfer a percentage to reserves. Please go to that point also. So we'll discuss this, and there is a small amendment also in this particular thing. Okay, with respect to corporate dividend tax that we have to incorporate. Okay, so we'll meet in the evening. Sorry for closing the class a little early. We'll meet in the evening, and where we will see final accounts of companies, and we will see cash flow statement. Today evening agenda is final accounts of companies and cash flow statement. We are comfortable. Tomorrow morning we will see banking, electricity company, insurance company. Tomorrow evening we can complete this accounting standards. Then auditing, I will give you guidelines with respect to the kind of question that is tested and kind of answers that you have to give, or kind of answers that you have to key in, kind of a thing. I will upload the video. I'll upload the video.